This is terrifying. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, the global financial system is failing as a resurgence in China debt defaults is threatening an all-out crisis. And I want you to understand where this crisis is coming from, because if you think back, all these policymakers and central bankers, they've got together and they said, look, we're going to put a firewall around the financial system. We're going to make sure that there's no further problems. And now out of nowhere, we're starting to see an uprising in China debt defaults. But here's the big kicker. What I really want you to understand is why these defaults are coming to America and not too far in the future, because the same catalyst, the same reasons we're seeing an increase in China debt defaults, we're doing the exact same things here in America. And yet, as we know, the Fed and central bankers remain absolutely clueless. We'll show you, we got a whole slew of them talking today, and we'll show you why they remain just in a whole nother world about what is really wrong with the financial system. And we're going to make a surprising prediction about the debt default. Let's over to Bloomberg, where we picked today's story up with a headline: 10 billion property bond defaults are just around the corner as Chinese local governments are tightening their oversights of developers' pre-sales process. And this is probably the key point today's show, is because when you see financial conditions tighten or lending standards start to tighten, you've paved the way for an increase in defaults. We see this in every cycle, and yet what happens? We make the same mistake over and over again. Despite these tailwinds, defaults are back. Now remember, they were supposed to be gone. And here we can see that KWG Group, one of the few developers, obtained a state guarantee. Now mind you, a state guarantee for its latest yuan note issue, said it had failed to make $119 million redemption payment, thus triggering a cross default of all its $4 billion bonds. Now, so this is pretty impressive that the Chinese government, right? The government came out, the local government said, we will guarantee your bonds, and yet they still can't make the payment on them. You've kind of wonder, just what is going wrong there. Well, let's take a look. Late last year, amid homeowner protesting installed construction projects and threats of mortgage boycotts, Beijing raced to ensure that builders could deliver pre-sold flats to disgruntled buyers. All bureaucratic resources were deployed. State-owned banks quickened developer loan approvals, and municipalities launched rescue funds. So what's important to understand, if you missed the whole China story, is that unlike here in America, where you kind of put a deposit down on a home, it gets built, and then you purchase it, well, in China, you buy it before it's built. So if it's not done on time or it takes too long, people start to get upset, because guess what they're also doing? Not only do they borrow the money, they're making payments on that loan. Again, that's something here in America we don't do, and that led to a huge uprising and almost an outright collapse in the Chinese banking system, as a bunch of borrowers said, hey, you know what? If you're not going to deliver, we're going to stop paying. And of course, as we know, the Chinese developers, the property developers, are functionally running a Ponzi scheme there, because they're taking money from the sales of new units to pay and finish off those old units before it's too late. So let's take a look at what the government did to try to protect this and why it's not working. Pre-sales, where apartments are bought before they are built, is a predominant business model in China's real estate market. Once a contract is signed, as I said, a home buyer's down payment and mortgage proceeds from the bank are wired to an escrow account where the developer can access that money as only construction progress. But get this, some builders siphon those deposits away for other purposes, resulting in stalled projects and angry customers. Now what they've done is they've changed how these developers can access their funds, and by cutting off access to escrow accounts inevitably sends many into distress. And what are we seeing already? Tightening at the local government level would deal a fatal blow to already vulnerable builders, and we're seeing it already, because as I've said, they're running a Ponzi scheme there. But is the issue just what the government is doing and these local governments kind of restricting the ability for developers to get their money? Well, no, the problem is much bigger, because again, this isn't what we have going on in America, but once you understand the basis and the catalyst, it'll make a whole lot of sense, because part of the problem here is the Chinese economy is slowing. As the Chinese data dump, total disaster. Youth unemployment hits record high. This from a week ago. We're going back and look at this. You see fixed investment falls. Property development investment fell. Retail sales rose only 18.4%, and that was under estimates. But here's the key thing I want you to see, because when you talk about the economy, the global economy, you need to see industry working, particularly in China. But look at this. Industrial output falls to 0.47% month over month, barely even rising. The year-over-year rate of change slowing down. And here's the problem. Youth unemployment soared to a record high of 20.4%. So you look at China's situation, you see a slowing global economy. As the world's largest exporter, you see the industrial production starts to drop. You see youth unemployment starts to go higher. What do you think is going to happen in the real estate space? Do you think people are going to have the ability to go buy new units and finance them? Well, you're right. They probably don't. But there's part of the issue. So you have a slowing economy. You see in the government sector, the local level, they're tightening how money gets accessed, and it doesn't stop there. Because China's central bank now faces more rate cut calls to spur growth. And this has come with somewhat of a surprise, because here in the U.S., nobody thinks the Fed's going to cut rates. And if they do, they think, well, it's going to be a little bit, but then we're going to go back on a higher rate cycle. We're never going back to zero. That's never going to happen. But already in China, they've cut rates, and now they're getting pushed to cut them some more because of what's going on in their real estate sector. You start to see an increase in defaults. What do you expect is going to happen at the central bank level? Well, if you said they're going to cut rates, you got it. The PBOC last cut the reserve ratio requirement, or the amount of cash banks must keep in reserves. Remember, here in the U.S., that's zero. It's zero. They don't have to do anything. Lowering it by 25 basis points. The rate on the PBOC's medium-term lending facility, its one-year loans, has been kept unchanged since August. So, they've been kind of maintaining, cutting a little bit here, but the expectation now is they're going to cut even more, because something unexpected happened in China last week that many people didn't even pay attention to, and that was this. That China suddenly buys treasuries, U.S. treasuries, amid March U.S. banking crisis. Now, again, this is something that nobody said would happen, that China doesn't want our debt anymore. So what is going on here? Why the sudden interest in buying U.S. treasuries amid their own real estate crisis? Well, the issue is here. The reason countries like China buy U.S. debt is because they get dollars through global trade. So when global trade is expanding, they increase their amount of dollars they have, and then those dollars in their local economy, inside their country, become inflationary. So they convert those dollars to treasuries, send those dollars back to the United States. But the question is, if the global economy is slowing and trade is slowing, contracting, why would they be buying dollars? Well, simple. Or why would they be buying treasuries? Well, the answer is really simple. They're selling their yuan. They're selling their currency on the open market to get dollars to buy treasuries. Why they would do that? Because they've got to maintain their currency peg. You'll note that as the dollar weakens, China's got to keep their peg below that. So how do you do it? Well, you can forcibly devalue, or you can go out in the open market, dump your own currency, buy dollars, and then use those dollars to buy treasuries, which is exactly how the system works. And what did we see Zero Hedge kind of mention here? They bought more treasuries in March than it had since January 2021. It's a simple function, my friends. A weaker dollar here is forcing them to buy treasuries. So why is the issue here is we're seeing the global economy slow down. That's going to affect the United States. But on a bigger level, it's the tightening of lending standards. So in China, you see at the local level, they tighten standards, but not directly, as we're doing here in the U.S., but indirectly by limiting how the developers access their money. But why this is going to hit America is because we're tightening standards here, and we're already starting to see the effects of it. This from the Wall Street Journal, as home prices posted the largest annual drop in more than 11 years in April, as sales of previously owned homes fell 3.4% from the prior month. And talk about, again, something that shouldn't be happening, particularly as we head into the warmer months and we head into the summer season. As school gets out, people look to move. You would start to expect that home sales would go up. People would start putting offers in, engaging in contracts, and looking to make the move. And then all of a sudden, this happens. Now, the question question, what's interesting here is you see a big move higher in home builder stocks, and you'll notice they're back. This is the ETF ITB. In fact, it's back not too far from its all-time highs, because what have we been seeing is home builders are super enthusiastic. They think they're going to have a booming summer amid even higher interest rates. But if we've made the case in the show before, this is a function of declining demand here. Now, if there's only one way to figure out when that chart was about to reverse, if you were in this trade or looking to get out of it or maybe short it, there is one report, that's our CTA-Timer Pro. It tells you when you're hitting extreme positions and when you should start to make a reversal. It's a great product. There's a link in the description below. It's $30 a month. There's even some video guidebooks that are open to the public. You can go there and watch them, learn how it works. It tells you when it's time to take a reversal on this. And I can tell you it's probably sitting at extreme positions now. As the U.S. existing home sales, which make up most of the U.S. housing market, fell 3.4% in April, but here's the bigger issue. The home prices fell 1.7% in April. Now, I know you're thinking 1.7% is not a big deal in itself over a month, especially considering how much home prices have risen. And you're right, that is the case. But let's look at home prices here in the U.S. on a year-over-year rate of change. And what we see in this chart is exactly what we'd expect to see as we have recessions or head into an economic slowdown. The growth in home prices slows and sometimes even contracts. We would expect to see during expansion, home prices are rising somewhere around 5% a year, which seems to be a level that many people like. And then you see that slowdown heading into recession, and we're seeing again. But if you look at this chart long enough, you'll start to do what I did, and you'll say, wait a minute, this looks like some other charts that we've seen on this show. And if you said that, well, it does. Here we can take a look at the net percentage of domestic banks tightening standards. We're going to use the commercial industrial loan data just because we have quite a bit of it. They don't have in the Fred database all the other data, at least going back as far. But we're going to look at commercial industrial, and I do agree that this doesn't transmit directly to home prices, but I want you to see the correlation is pretty similar here. And we can note that when financial conditions tighten, when banks tighten lending standards, this would apply to the resale market, to the home market. You'll notice when the blue line goes above the horizontal black line, what do you start to see happen? That growth rate in home prices starts to roll over and slow down. And that happened here in the dot-com bubble. Let's fast forward now to the global financial crisis, where we had a rapid tightening in financial conditions. And notably what happened, you started to see a slowdown in home prices, and then a contraction as the banks tightened standards. You can see just briefly during the pandemic, standards tightened so quickly, home prices didn't have time to really budge before the stimulus hit. But look what's happening now. You see tightening lending standards, slowing growth in home prices. It's all telling us this ties right back to the banks. And of course, where do the banks, why are they tightening standards here? Well, they're not doing it for the same reasons China's doing it. They're not doing it to keep these property developers from accessing escrow accounts, because that's not how it works. Right? We know the property developers here, they borrow money from the banks, they build the home, and then they go out and sell the home after they get, of course, they have a deposit from the potential buyer, which is why we tend to see a lot of developers here fail during recessions, because they're the ones holding all the debt, not the buyers, a case in China where they would be holding it. But now let's look at this, because we already knew this was going to happen, because the bond market has been telling us. Now we've got that 10-year, 2-year yield curve, which is showing and highlighted where it's inverted or near inverted against home prices. And so what does this mean is, as demand or as problems in the bond market show up, it leads to less home buying. And it tells us that financial conditions, this is what the bond market's telling us, my friends, is financial conditions are tightening. We're seeing less new loans become originated. You have less money created in the economy. It makes it really difficult to support higher prices. And what do you see? Lo and behold, the curve inverts. You see a slowdown in home prices. You see the curve invert, slow down in home prices. Curve invert, slow down in home prices. See, rinse, repeat over and over and over here. So the issue, it all again is coming back to central bankers who are so fixated on inflation, they can't see they're about to trigger a financial crisis at the same time as the synchronized global recession. And in turn, even policymakers aren't focused on the problem because they're worried too much about this debt ceiling. We'll come back to the Fed here in a moment, but I want to touch on this first. As Biden-McCarthy meeting on debt limit comes, as time runs short, yes, we're running out of time really quick because we know, as Janet Yellen has said, Treasury Secretary Yellen, the U.S. could run out of funds and make good on its payments as soon as June 1st. And of course, some people are now saying that that balance would actually make it to around the mid part of June before things got even worse, leaving us the question is, how is Wall Street preparing for this? Well, I'll tell you this. Here's my prediction, and then we'll look at the answer here in a moment. Is my prediction is by the weekend, by Friday, maybe Thursday, late Thursday, or sometime Friday, there will be, by and large, in a big agreement. There may be some little loose ends to tie out, and they're going to come out. Both sides are going to say, we won, we got what we wanted, and we proved to the other side that we were tougher. Over the weekend, they'll kind of tie up those loose ends, and somewhere around Tuesday, they'll ink the deal. And if they don't, if we go into overtime here, look at what everyone's saying. Even a short breach of the debt limit could lead to a spike in interest rates, which we've proved wrong, a plunge in equity prices, which we agree could happen, and amongst other things, since telling us the short-term funding markets would likely freeze up. But of course, that's not the case. What do we know will actually happen is the Treasury has enough money coming in to pay on all the bonds. They'll just extend the maturity out until the debt ceiling is lifted and they can borrow money and pay off all the bonds that are maturing and reissue new ones. That's what they're going to do. In the meantime, let's take a look at the Fed now. We heard today Fed's board sees 2 more interest rate hikes needed in 2023 to cool prices because all the hikes so far aren't working. He says, I think we're going to have to grind higher. I'm thinking 2 more this year. He added, although he wasn't sure when those would happen because, well, the economy, as we know, may fall apart before Bullard gets his hikes. But he's not the only one today. Here we see Fed officials open to foregoing the June rate hike. As Neil Kashkari says, I would object to any kind of declaration that we're done. And why would he? If the committee chooses to skip a meeting because we want to get more information, I could make the argument why that makes sense. A skip to get more information is very different in my mind than saying, hey, we think we're done here. And of course, they don't want to be done because they want everyone to believe that they have this ultimate control over the financial system when they don't. Because really what matters here is the yield curve is telling the Fed that, look, you need to cut rates. You need to invert the curve because if you don't, bad things are happening. We can see every time there's an inversion, what do you know? The Fed's cutting rates, eventually cutting rates, eventually cutting rates, eventually cutting rates. And here's the point I want to make. I know many of you say we're not going back to zero, but look, we were at zero once. We were at zero twice. You know what 3 times is? That's where we're headed next because they can't figure out how to take the thing negative. And if there's any doubt about that relationship, here we can invert the federal funds rate against the yield curve. And what do we know? The yield curve is telling the Fed, look, it's game over. The longer you keep this inverted, the more likely a chance that you're going to blow up the entire U.S. banking system, trigger a financial crisis and a recession at the same time. But good news is, if your goal is to get inflation down, well, that's one way to do it. But a lot of people really won't like it. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.